U.S. Treasuries are no longer risk-free instruments, and they haven't been for some time.
Hello and welcome to Wealthion. I am Mario, the channel's executive producer, and today with me to answer your questions is Chris Casey, the founder and managing director of our partner, WindRock Wealth Management. Hi, Chris. How are you doing?
Hey, Mario, thanks for having me on.
Thanks for joining us, as always, Chris. So, as you know, we've been getting a lot of questions from our community, people that comment on the YouTube interviews or on our social networks. And I have some questions that I'm going to throw out at you, and we'll get your very informative, insightful answers. So let's start with the first one, and it's from Ken Triat, 2426, and he says, "Are you worried about commercial real estate? Commercial real estate, excuse me. Should we still be concerned about that sector, or has the worst already passed? What do you think, Chris?"
Yeah, my gut would tell me there's still a lot of pain to be felt, and that's primarily because, and I'm not a commercial real estate expert by any means, so I don't have a ton of statistics I could pull, out of a hat and have at the ready. But what I do know is that a very large amount of commercial real estate was refinanced at obviously record low rates, and a lot of it's coming due,
Hmm.
including this year. When that debt matures and they have to roll that over, the issue is that the new higher interest rates on this debt may not make the property viable anymore, right? Because you're adding a huge expense to the P&L statement. So that is a real concern, especially because occupancy for, let's say, office is
Right.
still not where it was in pre-lockdown period. So commercial real estate, I would suspect there's more pain to be felt. But having said that, I should caveat that and say real estate is obviously local. That doesn't mean any particular property someone should not look at because their fear of commercial real estate in general. So I would encourage people just to think locally. There's always opportunities in real estate, but in general, yes, I think there's a lot of pain still to be felt in the commercial space.
Right, that makes sense. Is there any case where you think that we're past the pain point of commercial real estate and it would be a good idea to get into the space as an investor? Or that's really, you think, an area that it's way past its prime, giving, remote work and the the amount of online shopping and shipping, right? Where people are not really going to malls and that sort of thing.
Yeah, there's certainly structural changes that have taken place, whether they were just natural, like you're talking about home deliveries with Amazon and Walmart, et cetera, or if you're talking about not natural, like the lockdowns, which created a whole bunch of disruption in the office space in particular. But the commercial space is obviously quite large. So there's a lot more besides office. There's hospitality, there's a whole bunch of things you could look at. Um, so as far as when to get back in, I'm not sure. I think anything once it falls 20, 30%, it's worth looking at. However, like I said before, real estate's very local. So I would be very hesitant, even with the new administration, I'd be very hesitant to get in blue states. Certain cities could be continue to be problems, whether it's crime, what have you, for some time. So in general, I think there's a lot of risks still there, and still until you get paid for it by prices coming down, you may want to hold off.
Yeah, that makes sense. It's also like a very contrarian stance, right? Waiting for the pain, this 20-30% pullback, as you mentioned, and then to get back in. But it sounds like you need real local knowledge when it comes to real estate investing.
I would say, and industry expertise. So if you're going to invest in hospitality, you better know that industry, right? And this is not unusual whenever you have a big decrease, because some people may be shocked we're talking about this, 5 years after lockdowns. But there's a couple reasons we are. One is that, like I mentioned, there's a lot of debt to be refinanced, so that's a
Mhm.
big problem. Two is that there's always a lag, and you see this in any industry, but especially privately held businesses and real estate, where there's a lag between the bid and the ask, what the sellers and buyers are willing to pay.
Right,
It
really
takes
new.
them a long time to come back to an equilibrium where they can clear the market, and we're probably not there yet. It's probably got to fall a little bit more.
Right. Sounds like there could be a lot more pain and probably for the banks, right? Yeah, okay. Let's go to a second question. from our community, and this is from Manish Doshi 5915. Is he's wondering if it makes sense to buy the 10-year treasury right now, and what's your take on that idea?
Oh boy. Well, what I would say is that we're not big proponents of long-term bonds, and we
Thoughts?
haven't been we haven't been for some time. We're at the very short end of the range. I think there's a lot of potential problems at the long end of the bond duration, primarily because I think the U.S. fiscal situation, it's been out of hand for some time, but I think this may be the year where people start to realize it's out of hand. So just put some numbers to it. You got around 37 trillion in debt. The government brings in less than 5 trillion. They're probably going to run a deficit this year of 2. And you could make an argument that things are going to get better if the administration cut the budget quite a bit, cut spending, let's say 20, 30%. Then it's a different conversation we're having. But the reality is, and we haven't seen it yet, but in a month or so, we're going to see their new proposal, their budget proposal, and I'm pretty sure spending is going to go up, not down. Now they may promise a whole bunch of cuts over the next 10 years, but we've seen how that really plays out when you promise something in the future. And if they don't do it this year, as far as cutting the budget, I don't think they're going to be able to do it next year because then you have people, congressmen, looking at reelection. It's going to make things very difficult. This was the real opportunity to do something. And so I think by the end of the year, to fully answer the question, I think that's when interest rates may go up. I think that's when people have real concerns about the fiscal situation. That's when I think we're going to have our own moment. Um, Guilt is a reference to the British 10-year treasury, which went up basically a full percentage point, 100
Right.
basis points,
Mhm.
in about 4 days back in October of 2022. So that can happen here. And so I'd be very reluctant to invest in long term bonds at this point in time.
It would be really, really scary if we have that bond tantrum, right? That the vigilantes coming back, and you've talked about this in the past, right? How unsustainable the fiscal situation for the states is, and that the market just might ask for way higher yields that we have right now.
And by
Is
the way,
there? Yeah, go ahead.
it's especially more likely now, given what
Correct.
I would call the U.S. regime's financial repression of various state actors. Right. So
Right.
when you start taking offline, historically buyers of treasuries, whether you're talking about the Chinese, the Japanese, Russians, what have you, that means there's just less people willing to buy what you have. And if you start doing that enough, that just compounds the issue. And I think you are going to have higher interest rates down the road here.
Right. Yeah, it might have to happen to attract those buyers, right? Or else you only have the Fed as a buyer, and that, well, it just means hyperinflation. There's some people that think that hyperinflation is really the only answer to tackle the debt load. Is there then a credit instrument that you think would give people, safety of principle that they will get their money back, but still earn some return right now, like short-term debt instruments? There's something like that to kind of follow up on the viewer's question. What do you think?
Sure. I forgot to mention, not only should you be worried about long term um, bonds, just given interest rate risk, but with treasury bills in particular, treasury bonds, you have the issue of what I call a real solvency. So we talked about the fiscal situation, which may call for higher interest rates.
Uh-huh.
But on top of that, I mean, default is not out of the question. Now, like you alluded to, I think it will be a stealth default where they effectively inflate the currency so they never, rescind or renounce, their obligations directly.
Yeah.
I do see that happening down the road. As far as what to do, then, if you want longer duration, it's really just goes to the credit worthiness. There's plenty of companies obviously that issue stuff. As long as credit the credit is there, that may be something you want to look at. But U.S. Treasuries, I think, could be very problematic for a not too distant future for some time.
Pretty incredible considering that Treasury used to be, the risk-free financial instrument. It's amazing that we've come to this stage.
They
Okay,
still call it the risk-free instrument, and it goes beyond just commentary of saying that. That's actually what an analyst would use
correct.
to calculate future cash flows. So it does affect pricing across the board. And I have long thought, now that we have, I think, the third rating agency finally downgraded U.S. debt, There should be a premium attached to U.S. debt when you're making those calculations, because otherwise it throws everything off. But I do believe, yeah, the U.S. Uh, Treasuries are no longer risk-free instruments, and they haven't been for some time.
Correct. Yeah, great answer. Let's go to the next question. That comes from Timothy. I'm sorry if I'm butchering your name, Timothy, but Timothy O'Harley, 5391. He wants to hear your thoughts on oil. Is it still a good investment right now, or has that ship sailed?
Well, I would say that energy in general we like. And we probably like it for two reasons. Number one, from a valuation perspective, energy is one of the few sectors where you're actually going to have real value. And so that's where you're going to find dividend yield, right? It's one of the few areas that's actually going to have stable, nice dividends. So that's one reason we like energy in general. The other is that I am a firm believer that the AI trend is a nice, a very strong long term trend that everyone needs to be invested in,
Right.
and we view energy as a stealth way to do that, because the reality is, whether it's electrical output or distribution, there's a massive amount of investment that needs to happen in the United States alone to fulfill AI demand for electricity energy consumption. And the only way to do it is at the massively scale up U.S. energy. And as far as that relates to that, it'd be great if we could do coal. I don't think that's really going to happen. So I think natural gas is the most likely um, contributor to expanded energy output in the U.S.
Right. And there's a lot of natural gas in North America and oil for that matter. Yeah.
A lot of
Um,
natural gas that's here, and now we can start exporting it too, because it's a kind of a local market until you're able
right.
to
There's
start
a
doing
huge
the LNG.
arbitrage between
Yeah,
what the price that the Europeans pay versus the gas price for the states, right? You just need the capacity for liquefied natural gas. Chris, but thinking about a potential recession, right? There's a lot of talk of recession right now that particularly with tariffs on China of 145% that completely collapses commerce between the US and China or likely will. Um, would it the price of oil have an impact? We've seen actually the price of oil come down quite substantially in the last month or so.
that's absolutely true. But I think, and this is a problem I made earlier in my career, of being too focused on demand and being too judgmental as to where price movements will be solely based on demand. Because the
That's great.
reality
Right.
is, supply is a big point too. And over the last 4 years, you had a very hostile US regime to any energy of any flavor outside of wind and solar, right? So when you have that kind of hostility, when you have that um, disincentives that are placed by various governments, so it's not unique to the United States by any means, right? We have that in Europe. I think there's been a massive underbuild by energy companies as far as looking for capacity expansion, looking for reserves. That's probably been underly funded over the last couple of years, and that obviously changes quite more slowly than demand does. So that could be a long-term trend where supply needs to catch up and it's just not able to. So you're right, demand does have a negative effect in price. I could argue a lot of that may be already baked into the current price, but even to the extent it's not, I think supply will reassert itself here down the road.
Okay, let's go to the next question. Thank you, Chris. So, Chris Bailey, 8565, sees Bitcoin as a safe haven in these volatile times. How do you think crypto fits into today's market picture?
Well, let me first say that we're big believers in Bitcoin and cryptocurrencies in general. We're probably the earliest adopters as far as wealth managers out there. I mean, we wrote our first article in 2014 comparing Bitcoin to gold, arguing you should own both. We probably had our first clients in it back in 2013. So we've been long time cryptocurrency advocates. Having said that, I would never call it a safe haven. And I think the market proved it as such in the spring of 2020 when Bitcoin got hurt quite a bit during the lockdowns. Ultimately, when there's a downturn in the markets, downturn in the stock market, you're going to have a liquidity crisis where everyone's selling everything. And Bitcoin will not escape that. Now, on the other hand, on the other side of this is that I mentioned this budgetary crisis, which I think we're going to have, or I should say fiscal crisis.
Hmm.
And if that happens, I think Bitcoin will do very well as other cryptos that act as monetary substitutes in any such scenario, just like I think precious metals will. So you have kind of some counteracting forces here, right? We have what I think is a long term good trend in crypto. But on the other hand, you could argue if there's a liquidity crisis, at the same time there's any kind of stock market downturn, you could see some big price hits.
Makes sense. And for a typical portfolio, and obviously, I guess it would depend on the person you're advising, the person's age. What sort of percentage are you recommending for Bitcoin slash crypto? Considering also what you said, right? In your opinion, it's not a safe haven the same way that gold is.
Well, it varies quite a bit, and obviously everyone has, like you alluded to, with age, different risk profiles, etc. Um, I would say that it's one of our positions that probably has the greatest range,
Hmm.
right? Where we'll have clients with quite a large percentage of their assets in cryptocurrencies, but that's what they prefer. That's what they want. So I would say it's the biggest range we have of any asset.
Okay.
But it would not be common to see people kind of a floor of like a 2 to 3%, I think is reasonable at any given point in time.
Right. Yeah. Okay. That makes sense. That makes sense. Interesting. Let's go to the next question then, Chris. And that is from Dan, the man's male. I guess that's his his handle. He says he's big on physical gold, but of course there are a lot of ways to invest in gold, like ETFs and mining stocks. If someone wants gold exposure today, what do you think is the best approach?
Well, there's a couple different ways to look at this. We break physical gold, and by the way, this question is not referring to silver as well, but that's a whole different conversation as far as incorporating silver as well.
Right.
We break into three buckets. So at the one hand, we believe we're strong believers everyone should have some physical gold. Physical gold you can get your hands on if you need it. That's bucket one. Bucket two would be what I would call um, the the securitized substitutes for physical gold. So like an ETF that would hold physical gold. And we would primarily own that just because it facilitates the buying and selling, changing exposure. It facilitates toggling between silver and gold, etc. So that's bucket two. Bucket three would be the miners.
Hmm.
And they do have their place. Right now, you can make an argument that the miners are extremely well positioned. You have costs that are finally falling for them after years of inflation, energy increases. You have record high gold prices. So everything's aligned up very well. And on top of that, I haven't seen a lot of bubble type um, talk about miners right now. So you don't have people talking about how much money they made in miners, or you don't see commercials for anything like that for gold in general as well. This is one of these bull markets. It's a little bit strange, but it's primarily been driven by demand from central banks, other actors, not from the main public. So the public is kind of underinvested. So that would also argue for miners going up, right? Because it's going to be an easy way for them to get some gold exposure. However, miners do have the issue of that they're gold stocks, and first and foremost they are stocks. They will trade like stocks. When we have a downturn in the S&P 500, you will have a most likely a hit to gold stocks. So if you don't have exposure, it's something you should consider. If you do, I would just make sure it's sized correctly, because I could see some temporary pain, although I do see a very nice long-term future for gold miners.
Yeah, I certainly agree. Just like with oil, right? The gold miners are positioned like they haven't in decades, I would say, right? With cleaner balance sheets and all-in sustaining costs. So what it costs for a mine to produce their ounces of gold. So that means just a ton of cash flow, of positive cash flow with gold price as it is right now.
And they're better management than they have in
Uh,
previous bull
True.
runs. So
Yes, right?
they
Buying back
go
stock.
yeah, gold miners tend to do really stupid things when the
Mhm.
gold price is high. So they'll overpay for assets, right?
Correct.
They'll do a whole bunch of things that they should not do. And if anything, my biggest concern would be some gold miners are maybe diversifying away from gold, right? That'd be like maybe my biggest concern with some of them. But yeah, it's kind of a new ball game where you have, I think, just better management overall. The fundamentals are very nice, but again, that may not translate into a nice return on the stocks. We'll have to wait and see.
Yeah, absolutely. It's certainly very, very interesting. And to piggyback on my follow-up question about Bitcoin and the portfolio location you recommended to clients, what do you recommend in terms of physical gold and miners? Is it something similar to Bitcoin or probably a little bit more?
Yeah, it would be higher, our precious metals exposure in general, if you include all the different buckets, because I do view that as a necessary bulwark against what I see as this fiscal irresponsibility coming down the pike here fairly soon. So, no, we have a fairly large precious metals. We have for some time, but it's also quite a bit larger, obviously, since the beginning of 2024, since gold's up, by 2/3 since then, literally. So, if anything, we may have to trim back. And if we do that, it doesn't mean anything about our prognosis for gold. It's simply because of just sizing decisions with clients.
Thank you, Chris. Let's move to the next question. So, Thomas Gell, D3C, says he's basically hunkered down. Wow. Holding mostly cash and only spending on essentials. Do you think that's a good strategy these days, or could it end up hurting him?
Well, it's an easy strategy to fall into, right? Because
Right.
there's so many reasons to be fearful of a number of things out there. It's very easy just to say, I'm just going to take my cash, gold, bullets, whatever it is, go live in a cave. I mean, it's a very um, seemingly reassuring type position, but the reality is, I don't think that ever works, except in the extreme circumstances. Everything's a matter of probabilities and that you have to weigh. So what is the probabilities that we're going to have a massive 1929, type Great Depression? What's the probability that we have a budgetary crisis, an interest rate spike? What's the probability that inflation then follows? And these are all questions that people should look at. But in so doing, I would never say 100% I'm selling everything. I'm just going to hold in cash because the reality is you could sit like that for years and that may be what happens. If you do that, you miss out on a lot of opportunities. So we're not market timers per se, although I think it has a place at major inflection points. Um, right now may very well be one of them. That's absolutely true. So this may work out for him if that's what he wants to do. I prefer the tactic of at least investing in some equities, some bonds, what have you. You can always add to it on any downturn. So at least I wouldn't get out completely, but look to add with a healthy cash position. So if you're at 20 to 30% equities, I think that's a much better strategy than if you're at zero.
Right. Yeah, makes sense, right? Makes a lot of sense. You can't really time the market, and what you're saying is mostly about looking for opportunities. Okay. Um, let's go to the next question. Thank you, Chris. And this is from Ricky ZCV. He thinks now's the time to move out of the US stocks and into European or German stocks in particular. What do you think about that move? Should US investors start to see and seek foreign markets?
I've seen a lot of commentary on this recently. A lot of people have a similar investment thesis, and it's pretty simple, right? Europe is very comparable to US in a lot of ways.
Yeah.
Europe, especially Germany, is very cheap right now. I would see statistics. People may say it's 30, 40% cheaper. And historically, that's a big anomaly, right? So people would argue you should definitely diversify outside the US and buy some so called cheap European stocks. There's a couple problems with that thesis, though. One is that I could argue the US market is overvalued by 40, 50%. And if you believe that, then you could argue that, well, maybe Europe is still at a premium. It's not cheap, only on a relative basis.
Mhm.
That's one problem. The other problem is that Europe has some of the same horrible issues that the United States has, but they also have their own unique issues too. So, for instance, immigration is a problem for both countries right now. Probably a bigger one for Europe, I would argue. But Europe also has the issue of energy. Okay, they're extremely energy dependent on foreign actors. That's a big deal. It's a big deal if you're going to invest in German industry if they can't power it themselves, right? Or energy costs are just cost prohibitive to actually make anything there.
Right.
That's a real concern. And the other issue, I think, this Russo-Ukraine war will become increasingly an issue for Europe because, assuming we don't have peace, you definitely have the US pulling back as far as support for Ukraine. And when you do that, we're seeing a lot of European actors step in fairly aggressively, promising aid, promising things the US never even talked about, right? Like boots on the ground or what have
Yeah.
you. So that I think could become I don't think it will be, but it could become an increasingly European issue, a European concern. So I think all things being equal, yes, Europe's cheaper based on pretty much any metric, but there's some very good reasons maybe why it is cheaper in my mind.
Yeah. Right. It comes to mind also. Foreign markets from third world countries. I think we call them now developing countries, And you're exactly right. They're cheap for a reason. There's lack of rule of law. There's just a lack of corporate governance, proper practices. But still, is there any market outside the U.S. that you think deserves some attention from U.S. investors so that they can precisely move away from that overvaluedness of the U.S. stock market, particularly in the mega caps? Um, Perhaps, I don't know, Canada might be just north of the border, right?
Yeah, well, I've looked at that same argument like you mentioned is made with emerging markets, right? They're cheap, they're historically cheap. Time to look at them. We're a little bit more concerned about emerging markets because I think they're basically a way to play China, and when you do that,
Mm,
I'm concerned about China, and so therefore I would
that's
think they
very
get hurt
insightful.
probably
Hmm.
for different reasons, right? So
Right.
I see that argument a lot. As far as you look around the world, where are things cheap? Well, they're cheap in a lot of areas that people don't want to talk about, right? Or they can't physically actually do anything about it. So, for instance, like Russia's or something like that. So, we'll have to see how it plays out. Nothing's cheap right now,
Yeah.
I would say, in the world, but certainly the U.S. is way up there, along with India and some other countries, as far as being historically all-time highs type expensive. Um, so, I can't pinpoint any particular areas, any particular countries that I'd say this is where you got to be.
There's been a lot of debate among Wealthian viewers about where the market's headed. Obviously, there's a lot of uncertainty right now. Kai, your BN3DP, one of our YouTube viewers, thinks we could see 4,600 or lower on the, I guess that's the S&P 500, but he did not say. Then Haha Masala says it's time to short stocks, and Manny Q0 points out that historically it's smart to buy when the market is down 20%. So actually, for viewers watching out there, a 20% a market that is 20% down is considered officially a bear market. So, with all these different views, what are you telling clients right now? What is your expectation for
Yeah.
stock market in the coming months, maybe in the next year?
Well, I think we're in a what I call a state of execution period. It's a little bit. I think things are on hold until we see this budget. That's kind of the next shoe to drop. It's the same time when the next budget's unveiled, when we have this moratorium on higher tariffs that'll be lifted, and we'll see how that plays out if there's not a number of deals. So I'd say all bets are off. The market could go dramatically lower based on either of those, if not a combination of both. There's a real risk of that. As
Hmm.
far as different ways to play it. One gentleman there mentioned, shorting stocks.
Yeah.
It could be a very dangerous game. God forbid you short something like GameStop and Roaring Kitty starts talking about it and it goes up, a factor of two or what have you. Um, I think options are always a great way to manage a portfolio's risk, right? Whether it's you can for a couple reasons. You can really dial in and assess or have less risk at particular areas of the portfolio. You have limited exposure, right? Unlike a shorting a stock where theoretically you have unlimited exposure. You have very limited exposure
Yeah.
with options.
Yeah.
That's a good way to do it. Um, as far as whether or not you should buy on any downturn, well, that's what everyone's been trained to do, right? For the last 30 years. We've seen that time and time
Yeah.
again, probably starting with 87 and Greenspan with that market pullback. I would say that you can't necessarily trust the Fed to do the exact same thing, perhaps under this administration, for various reasons. Number one, I think they'd have a hard time justifying a rate cut purely based on stock market performance, right? I know it's a well hidden secret that is one of their so-called mandates,
Hmm.
but the reality is that just doesn't make a lot of sense from an optics standpoint. So I don't necessarily know if they would do that unless there's a real downturn in the economy. So different ways to play this. Definitely win short stocks. Um, I would be very defensive, but although I disagree with their comment that it's always a time to buy when it's down 20%, I'd say it's a time to nibble, right? And
Right.
you increase your exposure as things go down. There's nothing wrong with doing that. There were some real bargains here recently, which may or not still exist, but there's always opportunities. So they should definitely keep that in mind when they're buying. I would keep a healthy reserve to keep buying on future decreases as well.
Right. So no more Fed put. No more Fed put.
It may
Never.
exist. I'm just saying it's. I could see them reacting. Maybe it's out of spite for Trump. Who knows? There's a lot of motivation, I think, to so-called assert their independence. When in reality, that's just your thumb in their nose at Trump. So we'll see how it plays out. But I don't think you can automatically assume there is a put, although there may very well be.
Right. Yeah, that makes sense. Chris, there's no more questions, and I want to encourage our viewers to please comment and share with us their questions for a future episode with you. But before we go, can I ask you where viewers can find you? Where can they get in touch with you?
Yeah, I'd say the two best resources would be our website, windrockwealth.com. We have a research page there, which is pretty much everything we've ever written or spoken on, including all of our Wealthion uh, podcasts. And then also, I think X is a great way to find us. So at WindRock Wealth, you find us there. We try to post everything, latest news, etc.
Correct. Yeah. And as a reminder to viewers, if you go to wealthion.com/free, you can also fill up that form and get in touch with WindRock and Chris and his team directly. Well, Chris, I want to thank you very much for joining us. This was a very interesting, super insightful. I learned quite a lot today from you. Thank you, sir.
Thank you, Mario.